All right, so 2 weeks in a row, we ended the week on a high note. This time, thanks to Apple. Apple was able to overcome earnings announcements from Amazon and Facebook and Google and Microsoft. They're all very, at least the market's reactions were subpar. But you can see that Apple continues to be the behemoth it is and the #1 market leader, as it by itself pretty much led the market higher today and got us back on track for next week, which we have a big FOMC and there's a lot of chatter about the Fed tapering its rate hikes, which would be an unprecedented move, but it would not be unprecedented in terms of the Fed stepping in to a market that's in a correction and dialing back its restrictive policies like it did in 2019. So we're going to break that down, talk about the significance of this week's move, the past 6 days move. I'm going to talk about the signals it produced and how bullish they were. I'm going to talk about some signals that may not necessarily confirm the bullishness. And have we seen those same signals before this year? So I'm going to break that down in today's video as well. Talk about how significant the 6-day rally was. What really has led most of this move, the 6 days? Does that tell us anything about how bullish it is? And then, of course, our trade idea on a very big retailer company that's giving us a good trade opportunity going into November expiration. We'll talk about how to trade that. So let's go ahead and get started. Today is Friday, October the 28th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel with this icon here or the subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can check out some of these things on the right. Come down here, click on that heart. It opens up this tab. Hit that like button. Also, click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers. You can do it right now while you're watching. We got up to be 2 away from 100 on Wednesday's video. So let's see if we can eclipse that milestone again on this video. I also wanted to give a shout out to Paul. So we really appreciate, I know, dollar, is not that big of a deal, you would think, but it is to us. So we really appreciate that and would like to thank Paul. And for anybody else who would like to show support for these videos that we're putting out there day by day, you can do that right here with these super things. All right, let's start off taking a look at the S&P 500 here with the market forecast indicator. And you can see the great move we had here at the end of the week on Friday. So here's every day, right? So we had really 2 consecutive Fridays now after a year's, quite a few, most of the year's worth of down Fridays. 2 consecutive really bullish Fridays here for the S&P. 1 expiration week, 1 Apple earnings. Of course, next week will be Jobs Friday coming after the FOMC meeting on Wednesday. So it'll be interesting to see if we follow through with this streak going into next Friday. Momentum line jumped all the way up to extreme levels. The near-term line came out of bearish territory. Now it's not back in bullish yet. Most likely will be, barring a tremendous reversal Monday. So that sets us up for the second straight bullish near-term bullish low. Because remember, this one was a bullish near-term low. It dipped, did not get in the reversal zone, only spent a day down there, maybe 2. Same thing here. Only dipped its toe, only a day, and we're right back out. So that's about as bullish of a near-term low as you can get. Intermediate line now easily in bullish territory now. We're easily above that 2.5% mark. So a very good finish to a week when it looked like it might be a little bit of that resistance would hold here. Apple comes and saves the day, essentially. Because remember, you had Apple and Amazon. Amazon was horrible, but it was really Apple that not only offset Amazon on this single day, but offset, because it had a couple days of weakness during those 2 days too. So a big move to the upside. Getting back to the 50% retracement of the decline. So you can see back over here, we hit that 50% mark initially on September the 6th, then again here on September 15th, and then now we're back up to it again. Just to kind of give you an idea, because we looked at this before in August to gauge that, the idea that this was going to be a fake out in August. Well, remember in August when we had gotten back up to these levels from where we were over here, the volume wasn't anywhere close, right? The volume right there, if you follow my cursor all the way to the right, you can see on this day the volume wasn't near those levels. And that was why we weren't too sold on this rally. Well, now you come over here and you say, okay, well, back on this day is when we hit that 50% retracement on the way down. So I come down here, I follow my cursor all the way to the right, about the same levels, and that's the volume we're at now. So again, another instance of a strong rally to the upside that did not have the same amount of volume or money flow that we had on the way down. Once we broke it on the way down here, we didn't follow it up, with the same amount of volume on the way back up. You also see that in the McClellan oscillator. And the McClellan oscillator, which measures the breadth of advancers versus decliners, again, you can kind of see, where we were on the way down. We were over here all the way at 0 at the same level, right? And then now on the way back up, we're nowhere near that level. And we tend to be at those levels whenever you are coming off of an intermediate low point like this, or coming off of a major market sentiment low point, right? You go back to the 2018, when we were coming off this major low point here, this major market sentiment low point, you can see that the McClellan oscillator at that 50% retracement was at minus 454. Fast forward to this level and we're at 75. So much better, and you can see we had hit minus 100 on that decline. We hit positive 100 on the way up. We hit minus 100 on this decline. We have not hit positive 100 yet on the way up. We'll see how Monday turns out. But you can see that we're not getting the same level of breadth and volume on the way up. And this is no little move, right? When you look at the rate of change here, the rate of change is, over the last 12 days, which is starting with that big engulfing pattern. And you can see it's a 9% rally. This is a really decent move. If I were to change this now to 9.05, the August move didn't get up to 9%. This one did. And you can see some of these others. These are all, this is a move that would break us off of a low point, whether it's an intermediate low point, whether it's a market sentiment low point, so in other words, a correction or a pullback, or even this kind of correction. This is the kind of move that starts that. But unlike those others, it's really lacking in a lot of areas, especially again volume and breadth. You can see on the DMI, again, as bullish as we are, the negative indicator is down below 20, so it's down there. But you can see the positive indicator just can't get going. It can't get above 25. Again, we've had this before. We had this in August when we had that 12-day rally. Let's go back and see exactly when those rallies were. This earlier this year, right? So we had, this isn't the first time we've rallied this much. We didn't quite get 9%, but we got 8 2/3 here. So this would have been on the 29th, July 29th, August 1st, coming out of that FOMC meeting. So July 29th, August 1st, if I remember correctly. And then over here was March 28th, March 29th. So interesting that there's 29th in all these, because we're October 29th right now. So when I look at the DMI for March 29th and July 29th, August 1st, you can see, well, here's July 29th, right there. You can see that 9% rally, roughly 8 2/3, got your DMI pretty darn high. And March 29th, right here, that 9% move, or a little bit higher actually, got the DMI up to 31. So both of these moves got really good DMIs. This 9% rally can't even get the DMI above 25, which is what you need it to be trending to the upside. I also mentioned too, from a Bollinger Band standpoint, I've mentioned this before, that when you're breaking a trend, you need to break through. You can see it even more clearly here. When you're breaking out of these red dots and we're breaking to the upside and reversing a trend, you need to break outside of these bands. Ideally, both the bands and the Keltner channel to start us off. Kind of like an overbought cluster in the market forecast when you're starting an intermediate rally, right? When, like for example, when this gets into the upper reversal zone, then a good cluster can help solidify that move when you're on a bullish trend. So that's kind of what we like to see on the Bollinger Bands, but we're not. We're in the upper quartile, but we're not even in the value area yet. Consider that. As bullish as we've been, we're not in the value area yet for the full year. We still have 70% of this year's volume ahead of us. Let's compare that to July 29th. Excuse me. That'd be July 29th here. And then this would be July 30th of the prior year. Right, so we look at that period, and again, very similar. We were not above the value area, and we went up a little bit more into mid-August, and then failed. Right, so very, very similar. And then let's look at March 29th, and then we'll look at March 30th from last year, so a full year. And you can see there we actually were above the value area, and we failed. So, but you notice we didn't get outside the bands on that March 29th. And you notice too, we didn't quite get outside the bands either here. We kind of did there on the 28th, got up to 100.62, but you can see we kind of stalled at that point and didn't really break out. Ideally, we would want to break out right over here. We just got a smidgen above that band right there, which is currently the 38% retracement, right about 400. It's important. Another important layer. I would say this 3,800 is a much stronger resistance than the 400. So this is a good breakout. This move has a really good chance to get us going on a new intermediate run. Like I said, you have dark green shading in a green line here. You have dark green shading in a green line. You're well above the 2.5% mark. You're above the market sentiment that's actually still falling and deeply in bearish territory. So, you have a lot of things working in our favor to a potential second consecutive near-term rally. We didn't quite get a nice, good, long near-term run here. But this has a potential of being a really good, because usually when you start an intermediate rally, you like to get a good, long, near-term run. Because on the bearish intermediate rallies, you don't. Right, on that one there, on this one here. This was actually a pretty decent near-term rally. It was the only near-term rally of that increase. But usually when you're bullish, when you're in a bullish trend, or starting a bullish trend, like you come out over here, you can see we had a good near-term rally that lasted a long time. Multiple weeks. Coming out of COVID, you had a near-term rally too that lasted a couple of weeks right there going into this little period right here, and you had a pretty decent one there, but this was the one that got you the intermediate line into the upper reversal zone. So when you're coming off these major lows, you usually like to start them with a good long, here's a good long near-term rally, again coming off of that intermediate low point. The near-term line didn't come in the reversal zone for quite a while. So we didn't get that here, so we really need to get that here. So we are pretty much either on the cusp of a near-term rally that could last a couple of weeks or 2 or 3 weeks. The typical time frame is 7 to 10 days, so that 2 weeks would be on the long end of that typical time frame. But considering you've been so bearish, you're starting a new run, that could last 2+ weeks here, where the near-term line stays in bullish territory, avoids bearish territory for a couple of weeks, where we could just be starting that with the FOMC and jobs and everything else kind of put in the election, pushing us into November expiration on a good long run to the upside. You also have seasonality in our favor too. So for the next 2 weeks, you can see over here, pretty much going all the way into November expiration. From this point on, you can see it's a pretty good move. This is a pretty, decently good bullish rally for the markets coming out of October expiration. Going into November, pretty much being the earnings season for October expiration. Just for some perspective, on the last post-October expiration move, would be over here. Let's just go to a 2-year chart so we can see it a little bit better. So here's the other post-October. So this is the earnings season, and you can see going into November expiration, it was a really good move to the upside. Let's go back a few other years and see. So that was 2021. So 2020, there's your post-October expiration, a little bit of a decline initially, and then a good rally into November expiration. Again, the significance of this is the earnings season, right? So coming out of October, going into November, a pretty decent move. In fact, you ended November expiration with a cluster in 2019, and then 2018 would be kind of the anomaly. But even in the context of a correction, you still had a pretty decent rally coming out of that week post October expiration and then into the middle, at least the middle of November. So even that had a pretty decent move, and you actually finished kind of flat for the options expiration cycle. So it kind of gives you an idea that, I mean, there's potential here to continue to be really bullish for a lot of factors, except for some really important factors: volume, breadth, right? I mean, what's really driving this move over the last 6 days? Because that's really where the front running started, and we've seen front runs before that have failed over the recent history here. But if you see what's really driving this price action, let's do from an asset class standpoint. Well, first of all, let me hit these other charts here really quickly. Ichimoku cloud, we're not above the cloud yet. Really good bullish above the blue and green lines. The rate of change for the 26 days is easily positive and will be, barring a dramatic decline. So that's a good sign. We don't have a trend developed here yet. So we're not above 50. We're not above 1. We're not above the cloud. So there's you can see that there's some interesting and really important factors that are missing here for us. Not above 60. So we still don't have that combination of being above 60 and getting above 150. If you look at some of these other charts we haven't looked at yet, like the weekly crossover, again, this is really bullish. Getting above the 10-week moving average to get the green arrow, getting a good bullish candle. The hull is bullish. The hull, you can see, has turned up on the, with another higher close here after a lower close, reversing that lower close with a good bullish move today. If you look at the weekly version of the hull, obviously the first bullish week that we've had above the 20-week still hasn't turned around this parabolic SAR yet, but you are coming off a pretty significant low points, the lowest again of the last 5 years, one of the lowest that we've had in the last 5 years, really one of the lowest that we've had in the last 10 years if you go out 10 years. So this is again measuring how far below the 200-week whole moving average we are, and you can see getting slightly above, getting a MACD. Now granted, the differential, the bar is about as big as we've seen here at the end of that bullish move. So let's see if we can follow that up with another good bullish week this week. Certainly do not want to get a lower close next week. That's for sure, especially this soon. The positive sign is we've had now 1, 2, 3, 4, 5, 6 days of 3 green arrows. It's just getting more than a couple is kind of what we need, and we've got it all across the board. So 3 green arrows all across the board here is a good sign. We are sitting above the 50-day moving average right now. With the MACD about as high as, the histogram is about as high as it was in all these other periods. Starting to roll over just a little bit, but we'll see again, getting above these Fibonacci lines, getting above the 50-day moving average now puts this gap into play of getting between the 50 and the 200-day. And getting to the 200-day would get you through, obviously, this 3,800, which I think is the biggest, strongest resistance we have, as well as it would get you above the 400 level, which would be the next layer of resistance. Not as strong, but still a layer of resistance with multiple Fibonacci areas here would fill in that gap. Though 2 resistance breakouts would be really, now not unprecedented because we had it here too, and that ended up being a fake out, and we saw the signs of that, and we're seeing very similar signs of it now, unfortunately, here. Weekly version of this, you are above the 17-week exponential moving average. The MACD is not quite above its moving average yet. You can see from the Dow Jones average, remember the Dow Jones has been so bullish. The Dow Jones is sitting right at its 50-week. It's so far above the 17 and the 30. I mean, this has been a tremendous month for the Dow Jones, starting it with this inverted hammer in Harami pattern, and then just a doji, and then boom to the upside. These are regular candles, these are not Hakinashi candles. So really good 2 weeks here on the Dow Jones, getting us back up to through Fibonacci levels, through the 62. Remember, the Dow is barely getting above 38, or the S&P. The Dow is well above the 62. The Dow is barely getting above the 23, or the S&P, barely getting above the 23. The Dow is up to the 50. Remember how important that 50% retracement is? Because everybody brought it up here, and remember how we never come back down when we got there here, and the whole, everybody on Twitter was talking about how when we break the 50% line like we did, you can see it if I were to move this, activate this drawing. So So when we broke that 50% line right there, that week the talk was we never go back down to retest those lows. We always go back up to highs. It's like 100% odds, and then a few weeks later we kind of forget about that, right? Well, we're back up to that really important 50% level again, right? Are we going to hold resistance again at that level where, again, you still have a ton of volume sitting up above us right now, or are we going to get through it this time? A couple other quick oscillators you can see. Oops, sorry. Or a couple other quick charts I want to show you was the intraday chart, 4-week high point. So that's giving us a positive Arun indicator here. Well, up to 100, and we're almost back below 30. I mean, this is really, really good sign from that perspective. The range and the volume you can see are starting to pull back, which is bullish, right? We're almost back, not quite below 2%. I actually like to be below 1% to get a good trend established, which that's one of the reasons why we haven't established a trend for so long to the upside, because we've been easily above 1%. So you have to get below the 1% to get a good trend established. And we can't get below 1.5. Well, on that peak, we got to 1.5. On this peak, we're still above 2. On this peak over here, we were 1.5. So you can kind of see the ATR is still pretty big relative to the price, still at bearish levels. Being above 2% is a bearish level. Getting below 2%, you're going to feel pretty good about us not being so bearish anymore. But the fact that we are hitting that 9% move in 12 days, similar to here, but with the ATR still really high, suggests, and the volume is still relatively high, suggests that maybe we're not as bullish as we think we are. The VIX is the same thing, right? The VIX is showing, the VIX really dropped this week. First time, the first week in a while we've had a good drop. We finished last week at 30, not this week, down below 26, but we're still above 95. And if you look at the VVIX is finished below 80 for the first time in a very, very, very long time, and for the first time with the VIX being above 25. Right, the last time we finished below 80, back over here in February of 2019, if you look at the VIX, the VIX in February of 2019, over here, the VIX was below 15, and we were below 90%. We're at 96%, and we're still above 20. We're double what we were there. So again, it kind of goes to show. And then again, that August peak, the August peak, you can see how low the VIX got there. The March peak, you can see how low the VIX got there. And so very similar moves, right, on the S&P in terms of 12-day returns. But this time, we're not flirting with 20. We're flirting with 25. And with the VVIX still much lower, right, than what we saw in the August peak, which was over here. And then the March peak, which was right in this area. So interesting to see that the VVIX here, when you look at this chart, we've had 2 straight weeks of 10% declines on the volatility of the VIX. We haven't had that all year. This is the first time. The only other time that we've been close to this, the last time, we've been close to 2 weeks straight was at the end of 2021 during the holidays before this all started. So if you look at this chart, you can see in the holidays here you had these 2 big declines, and then out of those 2 weekly declines you had that rally that basically started this correction, right? That of this year that has a very good chance of turning into a bear market, right? As we move towards that 200-week moving average, potentially get below it. The last time we did have 2 straight weeks of 10% declines or more was in May of 2020. In May of 2020, and then March of 2020 as well, close. We were at minus 9.86. But when you look at those moves, those are those 2 weeks in March right here. So the VVIX was coming off of 180, 184 was actually 187. So those are those 2 weeks of 10% or more declines. This was actually 9.86. And then the other 2 was in May, was right here, coming off of a peak of 133. We're coming off of a level where we're actually down, that we were at 102. So we were barely above 100 when we started this, and we're dropping below to, again, one of the lower levels that we've seen on the VVIX since, going back all the way over here. And you can see when we dropped below 80 in February of 2019, we had 4 weeks of increases. We went from 75 all the way up to 98 in February 18th of night. So if you look at February 25th, that 4 weeks starting with February the 25th. So if you look at the VIX, starting again those 4 weeks of February the 25th of 2019, right here. So this week you can see that we started to get some increase in volatility right over here. So starting with this week, you can see the VVIX dropped. With that drop, the VIX at the time was only 13. Remember, we're twice as big as that now. And then we had 2 out of 3 weeks, we had some pretty significant increases. In fact, we finished there at 16, which is about a 30% increase almost from where we were before we pulled back down and continued in the bullish trend. So needless to say, like, the VIX is much higher now. The VVIX is set up for, a move to the upside. And you can see when you look at on this chart again, what kind of move did we get coming off of that May 2020 when we had those 2 weeks in a row. We had a small week to the upside of about 2%. Then we had a 40% increase in June. The VVIX jumped up 40%. When this is correlated with the VIX, 95% correlated with the VIX, you can expect a pretty decent move. Let's see, this was the week of June the 8th of 2020. So again, this is kind of post-COVID, but we had that big, this is where we had the big, when we went parabolic there and we peaked and we had a little bit of an intermediate decline there. The VIX itself rallied 47%. So when the VVIX spiked, the VIX went up with it. Can you imagine if the VIX went up 47 or 20% right now, or again, that would be 5 points would be up in the 30s again if we just went up 20% right now. So again, that's the kind of move that the volatility is set up to do. With all these bullish signals on the market, it makes you wonder how bullish we can really be with all the other signals that aren't confirming it: volume, breadth, and now volatility. All right, now if we take a look at what's driving. So I told you I'd be look back at what happened over the last 6 days. We've been really bullish, starting with last Friday, going into the whole week this week. You can see small cap stocks really have taken off, up 8%. The Qs are also relatively bullish. They weren't as bullish. Like going into Friday, the IWM was up about 6%. The Qs were only up about 1.5%. So big discrepancy there, and the Qs kind of rallied again with Apple leading the way higher. Still about almost half of the gains for the 6 days that IWM has had. But you can see one of the biggest reasons for the decline is the dollar. The dollar pulling back. But the problem with the dollar pulling back is what it does for commodity prices. As you can see, commodity prices have really started to find some bottom ground here. As you can see, they got in the last couple of days, and so again, starting with that Friday, going through until really yesterday, or today, Friday, sorry, I'm doing this on the weekend, so up until Friday, and still we closed up above all these moving averages despite the pullback. But we went from being below all the moving averages to crossing all the way through them all and getting slightly above the point of control there, trading right around the point of control. So again, commodity prices appear to be starting to find their footing, with the dollar starting to pull back a little bit. And the dollar pulled back for most of this past 6 days. For the first 4 days, it really dropped. It's up the last couple of days. And you can see the other thing, again, is yields for most of this past week until today, until this 1.5, 7 basis point increase today had dropped too. But remember, again, the 10-year note can't drop very much. It's limited because the Fed will raise rates to 4%. There's 90% odds that the Fed will raise rates this coming week, to 4%. So it's going to be hard for the 10-year to drop below that, especially considering there's still pretty much, 90% odds that we will have. Let's see, let me close this one. It's still pretty much 90% odds that by the time we get to December's meeting, the last meeting of the year, let me just refresh this to make sure I have the correct odds here. There's still a 92% odds we'll be at 450. So what the futures market is saying is that if we don't get 75 here, if there's 20% chance we only get 50 here, then we will get 75 in December. If If we get 75 here, then we're only going to get 50 in December. And then, of course, you can see, so 92% odds that we'll be at 425 by December. And then you can see by February, we have a 90% odds that we'll be at 500. Excuse me, it's not 425. We'll be at 92%. We'll be at 450 by December, which would be that 50 basis points, and then a 90% odds that we'll be at 500 by next February. So 5%. So the 10-year note can't drop very much without, like I said before, creating what's already been a historically low yield spread. Right, the yield spread's barely ever negative on the 10-year 3-month, and now it's not only negative, but it's pretty negative. Right, it's we've dipped down to 8 basis points in the negative on the 10-year 3-month, because the 3-month is still at 4.11%, and the 10-year is down to 4.03, and you can see the 2-year, which is trying to anticipate what the terminal rate's going to be by the time all is said and done. We've been below zero for months now, and we're at a pretty decently low level as it is. So if the 10-year note were to start to drop from here, it would make that even more inverted, which would be now kind of historically low. So you can kind of get the idea that the markets really don't want this to come down. The markets really don't want the dollar to come down because of its impact on commodity prices. And what's fascinating about commodity prices, again, we rally, we have inflation. We drop, we have demand destruction, which would be recessionary. So which one of that is good for the stock market, right? Do we want higher inflation still? Do we want 1970s? Because inflation is going to come down. The money supply is dropping. Inflation will come down. But if stocks, if there's still renewed demand for speculation for growing and increase, then if we don't get the real Fed funds rate positive, then we'll go through a kind of a double dip, so to speak. I'm going to see where I can find the inflation. Here it is. We'll go through a double dip where inflation's come down, but then we just ramp back up again because the Fed didn't get the Fed funds rate high enough to break it, and until the 80s, where they got it finally high enough to break it, and that finally brought inflation down and stayed down at that point from then on. If we take a look at how the sectors have performed over the last 6 days, let's see here. Right over here. Nope, that's the 12 grid, sorry. It'd be right. And you can see green shading, dark green shading, green line all across the board. So everything's kind of ramping up except for a few things. We do have light green shading and utilities and real estate in the yellow line. And then you have a red line on communication services. Most everything, and energy, of course, is still your biggest one. But look how bullish we are above the moving averages on financials and industrials, staples, and healthcare. We've had this area of the market lead before, and that doesn't necessarily we've had this area, we've had IWM lead us before, but we've talked about this. This breakdown here that we're getting, and this week was a pretty significant breakdown on, we broke below the 200-week moving average for the first time on the Qs relative to IWM. And again, we had that in the 2000s too. You don't really see that here. We have to go back a little bit further on this. We had this in the 2000s. Here, let me go in 1990 on this. So you can see we had the Qs underperform IWM in another area where we had high CAPE ratios. We had relatively high inflation levels. It wasn't so dramatic then as it is now. But we had high CAPE ratios. We had the Fed raising rates. We had big sector disparities in the weightings with technology especially. And you can see what happened to the Qs versus IWM. We're not as high now as we were then, but we are pretty high. I mean, the PPO was at 25%. That's a really, really high level for the 52-week moving averages here post-COVID. And now we're coming down, and we're breaking the 200-week moving average for the first time. And that's, again, when you're below that, that's not bullish for the markets until those sector weightings that are so disparate, they're so different, start to come back in line, which is what happened here in 2003. And it continued to go lower from 2003 on to 2007. But the weightings in 2003 weren't so different. Like you had, all the sectors were more equal to each other, like they weren't at the tech bubble, and like they aren't right now. But going back to here and checking out that performance here of the sectors over the last 5 days, or 6 days, excuse me, when we've had this kind of front running, the Fed seems like the market's starting to front run the Fed announcing or starting to signal that they're going to go, start to taper, even though they've never done that before. You can see the biggest beneficiaries have been utilities and staples and healthcare and real estate. And I mean, these are safe haven areas, and they're outpacing the market and leading the market. Like, how bullish are we when our safety trades are leading the market? You also have industrials and financials. Financials don't make a lot of money with inverted yield curves. And so the fact that they're rallying and industrials are rallying, it's not necessarily, I mean, this has been a tremendous rally over 6 days. Like one of the biggest 6-day moves, again, that we've seen. Let me go back to this chart. One of the bigger 6-day moves, here, let me go back to the rate of change, and then go 6 days. So not the full 12 days, but just the last 6, right? Starting with that options expiration, and you can see we're up 6.5% in 6 days. That's these, starting with last Friday, going through all of this week. 6.5%, 6.4% is one of the bigger moves that we've seen. Right? 6.4% for the year at least. And even coming out of this year, it's, 2019, we never had one, a period like that. We had one with the vaccine in the presidential election in 2020, obviously with coming off the COVID lows. We didn't have one at all in 2019. We didn't have one at all in 2018. So needless to say, 6.4% in 6 days is a tremendous rally. And if you look at what's leading this rally, it's not necessarily who we want to lead the rally, because they're not the generals. They're not the bigger weighted areas in a market cap weighted index, which would be technology, which is slightly outpacing the market, but underperforming these other areas that are very lightly weighted in the S&P. And then you have discretionary, which is lagging behind the market, and communication services, which is actually down for the 6 days. So, and especially over the last few days, again, with the earnings getting hit by earnings pretty hard, and XLY getting hit by Amazon's earnings pretty hard on the last day. And then you can see technology was underperforming until Apple helped it the last day. So again, not necessarily the leadership in a pretty strong move, move that we would hope would start off a new bullish trend. That's not necessarily the sectors that we would want to start off to reverse a dramatic correction and start the beginnings of hopefully a bullish trend that will lead us back at least to August highs relatively soon, if not back up to the year-to-date highs, within the next few months or so. All right, so for our trade idea of the day, I want to actually take a look in the discretionary area, an area that was working really well. And one of those is Costco. Costco had been in a decline for the last couple of months. Walmart, Target, there was a time period where a lot of those retailers were really struggling. But they've had a good 6 days, a really good 6 days, to the point where Costco has made its way back up into the upper quartile of its bandwidth for a few days, back up into the 1 year value area, which is pretty darn narrow for most of this. So it's traded in a pretty decent range between 474 and 560. I mean, that sounds like a big range, but remember, these are big numbers, right? And so it's a pretty narrow. You got one volume node. This represents, remember, 70% of this year's volume. The other 30% split between up there and some down here. And you're right back near the point of control, right where most of this year's volume is traded. The price point, at least, where more volume is traded than any other price point. So that's a natural attraction level. You can see a lot of bullish, because of the 6 days, we had been bearish. Things are bullish now. It looks very much like the market. Dark green shading, green line on that chart. You look at this chart, you got the green arrow. You're actually above the 200-week or 40-week moving average as well. Big candle, as you can see down there. You look at the 3 green arrow chart. Oops, excuse me, look at the 3 green arrow chart here for Costco, and you can see, we're right at the 200-day moving average as well. So we have been well below it. Now we're back up to it. We had some pretty sizable gaps between the 30 and the 5200. We filled in all those gaps. So we're not necessarily bearish anymore. We had a bearish trend, but we're also not necessarily too bullish either. As you can see, there's no trend going, and we're still below the cloud, and almost exactly like what the broader market looks like. You look at the DMI for Costco, and it's relatively bullish. We are above 30 on the positive indicator, below 20 on the negative. The DMI is above 20 and starting to rise up again. So again, definitely not bearish anymore, but not necessarily the strongest bullish signals either. Slightly above 60, slightly above 100, but bullish enough to kind of move back into this area. So what I decided to do here is say, okay, since we were still in November expiration, for this last kind of one more day of trades we could do on Friday for November expiration, decided to do an iron condor. Sell at the low 20s, a little bit higher up here, mid 20s, because I can kind of manage according to where that point of control is, right? So setting up the iron condor, setting up the trade, and you can see where my break evens are, happen to be right smack dab in the middle of this value area. You've got the top end over here above the point of control. You got the bottom end back at the bottom of the value area. So as long as we stay in this area until November expiration, and you can see earnings will come out after December expiration, then that's how we make our money on this trade. And again, you can see how the Bollinger Bandwidth is rising, but again, what's making it rise and how much longer could it rise? If we kind of stuck around, we get back into this middle range and this slog of volume, now it's going to be a little bit harder for it to make its way around, especially make its way to the upside. That's why I brought this down a little bit lower. And then again, back to the downside, you're going to have the bottom end of this range that can help hold us up there. And if we break out either one of those lines, then you're going to be trending again in either direction. And we'll take whatever loss we have on at the time and move on to another trade. All right, well, that wraps us up for today. You've heard from me now. I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. So open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next week.